Welcome back to another episode of Brave Ideas. Today's episode is packed with insights from Andrew Dunn, Vice President of Flexible Workspace at Brookfield, which, depending on the day, is the largest commercial real estate firm globally. We explore Brookfield's innovative hybrid lease structures to integrate flex spaces into their global portfolio while managing risk and maintaining stability. Andrew offers a masterclass in the balance between growth and caution in the rapidly evolving real estate market. We dive into the evolution of flex and how Brookfield has embraced the trend over the years. Joining me to introduce this episode is my friend Sam Gamble, co-founder of Return Suite, our headline sponsor for this season. Sam, I know we've talked a lot this season about the growing trend of co-working and flex spaces, but Andrew's perspective on the stability aspect and the hybrid leases really got me thinking. After listening to this conversation, what was it that stood out for you?
Yeah, Andrew had just so many interesting pieces of information that he shared. One of the ideas I thought was really interesting was that, we might be finally entering into a period without any kind of major disruptions in the office industry. And so we have this opportunity finally to kind of get 3 to 5 years worth of operating data that can help back up flex without kind of these major disruptions like COVID happening.
Yeah, and I think the fact that they've got so much flex across their portfolio, they obviously see this as part of the future. They don't just see flex as a trend. Andrew talked about how the traditional office model is evolving with flex space becoming a key driver for NOI in some cases, but he talks about the importance of getting the right deal structure in place. How do you see the hybrid lease model unfolding?
Yeah, that's a good question. It was really interesting to hear how Andrew looks at it and how Brookfield looks at it. That, ultimately they always are going to want a lease because that's kind of the business that they're in. So although while he's kind of an advocate for flex, it's not unconditional. He's not, always saying more flex, more flex, more flex. Really, it's kind of an asset by asset case, situation by situation, and what fits best. And as far as kind of this movement into kind of hybrid, it seems to me that they take a really, really detailed look at kind of what the finances mean to Brookfield and how the arrangement will kind of result in kind of different financial outcomes in different scenarios. And they really, really dig into reporting is something that you found out.
Yeah, it was really interesting to hear how they asked for the model to be submitted by the operator, but then they do their own stress testing of that model on their end, and then when they do a deal with an operator, they've got monthly, quarterly checkups, but they take a friendly approach with it. I did think it was really interesting how Andrew said that Brookfield they're a certain profile and they work with certain types of operators and they only do certain deal structures, which is evolving. But he did make the point that what they do is not necessarily what everybody does. So it's interesting to hear that. And I think for me the biggest takeaway, Sam, was Andrew's view on the future. He did admit that flex space was probably going to grow, but he said it all hinges on corporate demand for flex. And he said if big companies start demanding it more, they'll 100% provide more of it. He said, but that's the key. And until that happens, it's a balancing act. And he's not seeing flex being asked by corporates a lot. So I'm just curious if you think maybe we'll see corporates and operators teaming up to come to the landlords like Brookfield.
Yeah, I imagine kind of over time, as kind of larger corporates want to kind of have more capacity for overflow space, they're going to start asking for more and more flex. I mean, they might not know maybe it's not on the menu, but you can always ask for it. As it gets kind of more and more well known as a solution for big corporates, I think they're going to begin to ask for it, and then the big landlords like Brookfield are more than happy and willing to provide it. So it's probably just that it's the nature of commercial real estate and long-term leases. These things just take a long time, but it does seem to be evolving that way.
I think so, and I think the episode gives a lot of food for thought for everyone on the future. And I think it echoes Kylie's sentiments from last episode around the transparency that you guys are helping provide for the industry. Let's go ahead and dive into the conversation with Andrew. I think as I said at the beginning, it's a masterclass.
This is a good one. I think everyone's going to enjoy this.
Welcome to Brave Ideas, Andrew.
Thank you. Good to be here.
It's good to be here with you. It's great to listen to your panel earlier, having a conversation on the relationships between operators and landlords.
Yeah.
Brookfield, one of the largest, if not the largest landlord in the world.
I think it depends on the day. Yeah.
Up and down,
Depends on what's going on with various different assets across the world, but yeah.
Who's richer, Elon or Jeff Bezos? It depends on the day, right?
Exactly.
But what I found was fascinating is you guys have 1.8 million square feet in your portfolio that consist of flex co-working space. So is it fair to say you guys believe in the growth of flex?
Yeah, and have for a long time, right? That 1.8 has been built up over many, many, many years in many cities, right? That's across the whole country. The US is our biggest user of flex at about 550,000 square feet. But, UK, Brazil, really everywhere that we have assets, we've seen co-working work, right? And so, during that huge growth time, we were certainly doing it, but we've been doing it for a very long time. This is not a new product for Brookfield. And so, yeah, we believe in it.
Expecting that to continue to grow?
I think we are expecting it to continue to grow, although, I think we need to have a little bit of a period of success as we continue to see it grow, right? We want to have some stability. It's been an interesting 5 years, so to speak. And so I think if we looked at our portfolio, if we looked at our growth, if we looked at how we're viewing co-working, you'd have to look at what do we have and is it working? And as we see what does work and where it works and what makes sense, you double down in those places, right? I think co-working is such a large word, flex especially is such a large word. To say that, do you believe in this one thing? Like, yeah, in certain places, in certain contexts, and with certain users, yeah, it makes a lot of sense. In others, not so much. So we'll see.
When you're thinking about this, and I get the stability, I understand exactly what you're saying there. Yeah. But when you decide to do a deal for flex, whether you talked about leases, which is what you would prefer, you talked about hybrid leases, which is what you're doing a lot of. Do you look at bringing that in when you do that deal because that's what demand wants? You're looking at it as an amenity for the building, or you're looking at it for a higher NOI? What's the driver for you? Yeah,
so I think in general, it's a couple of those things, right? The first is the amenitization is definitely a newer and more, being focused on more, I think, in today's world than it was before. And if this becomes kind of an expansion of that amenitization, I think it makes a ton of sense, right? And so we're certainly talking about that. We're certainly thinking about that. It hasn't been a huge pitch, right, from the co-working brands. Let us come do A, B, and C. It's always been let us come do co-working and we'll do 20% better than the market. As we look at, the amenitization of space and how co-working fits into that, I think it becomes a lot more attractive in a lot more places. But we're always looking for driving NOI, right? And honestly, what we're always looking for is to drive stable NOI. And so I think that's one of the challenges, honestly, that we've had with co-working is that stability of that NOI. And as we've moved from leases to hybrid leases to management agreements, right? And the truth is we don't really do management agreements. That is, I am the advocate in many ways at Brookfield for these co-working brands to try and get them into these buildings. And, that's the discussion I'm having of what does this look like versus a 10-year lease that we can sign in this same space? And why do I want to do this versus that? So you said hybrid many times on the panel. Yeah. You've mentioned it a couple of times here. Yeah. Can you define hybrid? What does that mean to Brookfield? Yeah, so hybrid has a fixed lease component, right? So there is money that is coming in no matter what the performance of that space is on a monthly basis, right? Very similar to rent. It's usually some portion of what we're trying to get as a market rent. We're always trying to get the highest percentage of what. So if someone says to us, we'll give you 95% of market rent and the rest is performance, we'll say, fantastic, we love that. The reality is you end up somewhere closer to that 20 to 60, right? And it is a large range depending on the asset, what we're trying to accomplish, what the co-working provider is willing to do. So let's use 50 as an example. So you're getting 50% of market rent, and then the rest is based on the performance of the asset, or specifically the co-working within the asset. So the better they do, the better we do. And usually it's a tiered approach. So we're getting a certain percentage of revenue up to a certain return, usually your market rent. Then the splits change so that it's more of a 50-50 split with the co-working providers. So again, the more they succeed, the more you succeed. It's a little bit of, you're all going towards that same path. And It de-risks it in many ways for the co-working provider, which is why they love it. It's why they're pushing for this. But it also allows them some of the runway that they need to sometimes be hitting home runs and sometimes be hitting singles and doubles and kind of continue to operate.
Do you mind if we unpack that a little bit more?
Not at all.
Just going deeper on that. So does that deal, it's a hybrid lease, but you're taking 50% of the market rent.
Yeah.
Is the rest of the deal the same market terms, meaning TIs or CapEx contribution, free rent, or does that all go out the window because you're getting 50% off?
No, it's all part of the deal, and they look very similar when you're looking at the build-out costs. Part of the difference is co-working is more expensive to build, right? And we talked about the challenges of co-working growth, and what we're looking at is we're looking at it against a 10-year lease. The more it costs us to build, the more money we have to expect to make on the back end, right? And so, it all goes into a spreadsheet, and when it comes out, you can look at it apples to apples versus every other lease we're looking at, and we have to make a decision. What is the risk profile of this versus that, and what do we think is going to happen in this space, and is it worth us doing?
So when you're underwriting and you're comparing it to, okay, if I can get a tenant to come in and sign a 10-year lease at whatever those market terms are, or I can do this hybrid lease over here, you can look at how much money you're going to make. You maybe put an IRR behind that.
Yep.
How much of your whole period and your exit price forecast, how much does that go into your thinking?
Always. I mean, that's always part of the conversation, although it matters what the asset is and what the whole time of that asset is, right? Brookfield owns assets in a variety of different funds, which have different horizons, right? Some of our stuff we'll probably own forever, right? Others, we're disposing of in 1, 2, 3, 4, 5 years, right? And so it really does depend. Does it make sense to put expensive co-working in a asset that you're probably going to dispose of in 1 year? Probably not, right? And so we're constantly looking at that. It's a major factor in what we're doing. That being said, we're constantly also trying to drive revenue in buildings, right? That's our job, is to maximize revenue to these buildings. So I think as we look at these spaces, if you say you have two options, a co-working provider in this and a 10-year lease in this, we're going to take the 10-year lease every time, 100% of the time, right? It's our business, it's what we do. We can underwrite that with 100% certainty.
But the big question is, how many of those are out there?
That's the question.
Yeah.
Right? That's the question. Is this the best use of that space?
Yeah.
Right? And the answer is sometimes yes, sometimes no, right? And so, yeah, that's why it depends so much on market, so much on even within the market, what the asset is, right? And even within an asset, where in the asset it sits, right? A 5th floor and a 53rd floor aren't the same thing,
sure,
right? And we obviously can't underwrite them the same way. So many factors that go into these decisions, which is why the idea of growth within this industry is very complicated, right? It's not a straight up, we believe in this, we will grow this. We look on it, every asset, every empty space that we have, what's the best use of this space, right? Co-working's in the conversation for sure. Does it always win? No, right?
Well, another question on the deal structure before we move on. So I interviewed co-founder of 25N, co-working brand in Indiana and Texas, Megan Slavin.
Yeah.
And she talks about how they started off with leases, they went to management agreements, and now they're seeing more of a trend of landlords actually wanting to do deals where it's actually a contract that looks like a management agreement up front. So all the components that you might think of there, but then at stability, it flips to a lease so the landlord can then capitalize. So, if they sign a 10-year lease, they get, some free rent up front, maybe some capital contributions.
Yeah.
If they do a management agreement, then there's no free rent because they're getting some revenue up front, but then they get the benefit of converting it to a lease to capitalize on that income.
Yeah, I think the problem with that is a mismatch in risk, right? You're taking all the risk day one when there is risk, and you're taking all that risk off the table day two when there is no more risk, right? And you're losing the benefit of presumably enhanced NOI because you're getting the performance coming back to you, right? So I get that in terms of, you can now go back to the bank and say, I have a lease in this space. That's great. And that makes sense in a lot of spaces. Or the buyer, right? And say, this is a lease. Then it goes to what's the credit of that lease, right? Because that's hugely important as well. What credit are you going to get for that lease? If it's with a, ghost entity with nothing behind it, still might not matter that it's a lease, right? It's still a co-working provider. You still have to, defend that tenant, no matter who the tenant is, or what type of structure the lease is. But that's definitely an interesting way to do it. And we've seen certain scenarios as we've been talking about leases where you have that flip, or you have the ability, for instance, if there's a performance metric that you're not hitting, instead of that space coming back to the landlord, they have the operator has the ability to say, no, we believe in this space long term. Let's flip it to a lease. So that's where we've been using that. I think part of that kind of differentiated structure of management into lease can be challenging, because the reality is you still have to get the equity behind the original deal to fund all that TI, right? And so the hardest part, I think, for us day one is $290 or $250 a foot, even $150 a foot. Where's that money coming from, right? So we're going to our bank and saying, we believe in this concept. We believe in this concept in this space. Here's the numbers. Here's what we think we can do. And we have to defend that. And they can say, yeah, we'll fund that, or no, we won't. And that's the challenge, right?
And when you do that, are you always doing a 50-50 debt to equity, or what's the typical ratio there?
Completely depends on the building. Completely depends on,
all variables.
There's so many variables into that, but we're definitely putting in less than 50% equity into a lot of these deals.
Hey everyone, Caleb here. Let me tell you about something that's going to totally change how I work with real estate spreadsheets. If you've ever been stuck in endless tabs of complex cash flow models, you know the pain I've experienced. I just saw a demo for Return Suite, and I've got to say, I'm excited to try it out. This platform is about to make our lives so much easier. You can model cash flow scenarios in minutes, not hours. It's like a breath of fresh air. And here's the cool part. Their co-founder, Sam Gamble, who helped kick off this episode, is looking for 3 beta partners to test their flexible leasing model. Whether you're managed co-working spaces or flex inventory, this is your chance to get early access to something groundbreaking. Let's simplify financial analysis together. Join me as a beta partner and check it out at returnsuite.com/brave. So moving into another topic, when you recognize that an asset needs some sort of co-working flex space as a service component, do you do a tendering process? And are there times where you're having 2 or 3 different operators present? And okay, so then when you do that, how do you get an apples to apples comparison?
Sure. So, whenever we have a space that we think makes sense as co-working, the reality is we have very good relationships with every major co-working brand, right? We've been doing deals with them for a very long time. So we have our contacts in any city, in any country, at all the big providers within the space. And so if we believe this is the perfect space for co-working, it should work, or we're getting a co-working space back with a different provider, right, that we think should go out to the market because that provider may not have worked for a variety of reasons, but it's still a viable business in a good space. We certainly want multiple opinions, right? So we'll bring it out to everybody. And the truth is, once they give their numbers, it's all comparison of what do those numbers look like, right? And so just like you would with any other RFP process for any other space, or even any other leasing process with multiple tenants looking at the same space, we look at the deal and we make a decision based on a variety of things as to what makes sense, most of which is what do the deal terms look like, right?
Well, I think one of the big topics that we've talked about today and last night with Ben Wright from Instant is, as that beauty parade happens, there's not really a single source of market data that a landlord looks at to benchmark against the proposals that the operators put forward.
Right.
Do you think there should be that single source or multiple sources of data that can be benchmarked?
Yeah, that would obviously be helpful towards modeling this all out, right? Everything else is kind of pie in the sky, but you have to believe in most of our markets and most of our places that we're looking at this, you have comps, right? So these are not just made up numbers, right? We're in major cities, we're in large buildings in major cities. When Industrious WeWork Regis comes to us and says, we believe we can get $1,000 a foot for the actual spaces, we then say, okay, what are you getting in these 5 locations that are within, X miles of that space? Why do you believe that you can get this? And usually they have a good answer, right? They're not making it up either.
Hopefully.
And then we run a sensitivity, right? Yep. We say, okay, what does this look like if they, instead of $1,000 a foot, they get $650, right? And are we comfortable with that outcome? So although they don't necessarily make it up, we have to look at the downside. We spend a lot of time thinking about what is the downside of all these deals, right? If this works out.
So if they're not giving you downside scenarios, how do you play that scenario out?
Well, we take their models and we adjust them.
Okay. Then,
and the truth is, we ask them to do it too. They give us sensitivities almost all the time.
We talk about the big brands naturally.
Yeah.
Do you do deals with smaller brands?
Yeah, I think it again depends on the market and depends on the asset. The reality of our buildings is we have very large buildings in big markets, and most of the people looking at that much space at those prices are the big brands. There aren't a lot of small brands that are willing to pay the rent to get into these types of buildings. And so I think that's challenging. And quite frankly, the credit behind these larger tenants is a lot easier for us to swallow and to take through an investment committee, for instance, than, hey, I've got 5 locations and we really believe in this space. That's fantastic, and I hope you end up with 500 locations and come back to me. But it's just hard for us, I think, in the assets we're in the buildings we're in, the locations we're in, to kind of take that leap. We don't want to take those leaps of faith necessarily.
So once you've done the deal, what sort of reporting do you expect from the operator when you do a hybrid lease?
Yeah, so
what sort of data points in that reporting? How frequent do you need to have a conversation?
So we're getting full P&Ls on pretty much a monthly basis, right? Because of that performance metric that actually affects how we're performing in that asset from a lease perspective. Our accounting team needs both that information as well as the forecasts, right? Because when you have a fixed rent roll, you know what you're making on that space for the next 12 months. When you have this kind of variable factor, we need to make sure we understand from a cash flow perspective what's coming in, what's going out. And so we get a full P&L breakdown for each of our spaces that are under hybrid leases. And we usually have, if not monthly, quarterly calls with the providers to understand performance and, what they're doing, what's going forward, what does the pipeline look like, what are these forecasts based on, right? So that we can better basically prepare our assets.
I imagine those conversations, if things aren't going great, it's more than just a reporting, and it's understanding why aren't things going great, what's the churn, how come you're not hitting occupancy. Are those conversations taking place?
For sure, and how can we help, right? We're a large organization with lots of different assets around probably this city. So what can we be doing? Should we be sending out a mailer? Should we be giving out 15% off to Brookfield tenants who want to come and use this space on a daily basis, whatever it may be, right? So we spend a lot of time working with, our various different operators who are not doing as well, and say, where can we be helpful to you? Because the reality of this game is, if you're not winning, we're not winning, right? So we want to do everything we can. And sometimes it's like we need more marketing within the asset, right? Or within the local area that you guys own tons of assets. Sometimes it's, can you reach out to your broker contacts? Because we've got a large suite that we're having trouble selling right now. And if it went through you, it might be helpful. There are lots of different things that we can do to try and help. And we certainly want to do.
We had a fun exchange when you were on the panel earlier. I was asking about, does size matter in terms of the footprint that goes into a building, which obviously depends. But one of the things that came out of that, you were talking about how the lenders aren't quite there yet to really buy into the premium that flex generates or can generate, and that revenue gets discounted down. And I guess my question is, if we fast forward into the future, you guys invest in hotels, which is very much operational real estate, flexible variable revenue. Do you see a future where the lenders get on board with a similar financing structure that hotels have?
I think they're not going to do a similar financing structure, but I think they will view this piece of the larger picture, right? Because when we finance a building, we're financing floors 1 through 60, not just the single floor that happens to be co-working. And I think our hope in co-working, not Brookfield, but just generally for anyone who believes in the product, is that with historical data and with the ability to kind of normalize that historical data, you'll just get more credit for what is a non-recurring revenue stream, or non-guaranteed recurring revenue stream on a go-forward basis, right? I think part of the problem is there hasn't been a long period of time that hasn't been interrupted by whatever it may be, whether it was the filing of WeWork to go public, that obviously blew off a bomb in the whole industry, and then it was COVID, which I'm not sure which one was bigger, but they were both bad, right?
Yeah, for sure.
They were both very bad, and so I think there just hasn't been a long period of stability, right? I talk about this a lot, this idea of stability. Maybe it's because we're this large landlord that's what we crave, right? We crave that stability in order to generate these kind of returns that we expect. And, do we want to hit home runs? Absolutely. But we also want to make sure we're hitting singles and doubles, right? We don't want to ever strike out. And so I think as we get that the stability over whatever period of time it may be, I think it's probably 5 years to be able to say, like, this is a performing asset, right? The co-working space works in this space and should be getting credit. I think that's a much easier argument to make than here's a pro forma and here's what we expect happens over 5 years. And they're like, okay, but how do we know, right? And the answer is you don't.
Well, we've been talking about the gap between demand and supply in the flex world, and there's been predictions from JLL, from others, on flex being 30% of office footprints to 50%. That recently came out from Instant.
Yeah.
If we see this period of stability over the next 5 years, and the financial markets give it credit,
Yeah.
do we see that the footprint, going back to the size matter question,
Sure.
could the footprint of flex go bigger in large office towers?
I think it's all driven by demand, right? If our office tenants ask for it, we're going to give it to them. But I don't think we're going to build something that people haven't asked for, expecting them to want it in the future, right? I think it's a little bit of a chicken and egg game where if you have these large corporates who are in our buildings already and are looking at all of our buildings saying, we want flex as part of this building, that's a different conversation than do we think we can fill this with small to medium-sized businesses who are using flex space today? That's a much different conversation. I think if we want to see growth in these large assets as it relates to co-working, it needs to be driven by the actual users and primarily driven by the users who are taking long-term space as well. So you're taking a 10-year lease on 300,000 square feet and you really want flex as part of that deal, and there are 5 of you in our building, flex becomes a really viable option in that building because we have confidence that we're going to fill that flex and that it's going to, and then the lender says, oh, your tenants are made at 40% up of large corporates who are already in the building. That's great.
When you're having these conversations with your tenants and when you look to underwrite a new development, you're doing your pre-let, are you having these conversations with those tenants and potential tenants to saying how much flex do you want in the building? Because I see these big corporates go in and using Desana, Upflex to manage that flex spend.
Yeah, but the reality is they're using that flex spend primarily outside of their home office, right? So they're saying to you, Andrew, you can work at Brookfield Place, or you live in Connecticut and you want to go to the local space, you can do that. That is not as helpful for us, right? Because we don't own that building in Connecticut. What we want is corporates to say, we're going to take this long-term big block of space, but we also want access to and will pay for a certain amount of flexibility that you can give us in co-working. Those conversations, have not been as prevalent to date. I hope they are. I hope they continue to grow. But it's not something that I think we're seeing a ton of. We don't have a lot of our large occupiers saying, this is great, we're taking massive amounts of space, but we'd love some co-working in the building downstairs so that we can grow into it. And maybe that's just we've been talking a lot here about Brookfield is one type of landlord, right? There are lots of other landlords with whom flex makes a ton of sense, right? If every dollar that you make from this deal goes into your pocket, you love something that makes 20% more than a market rent, right? That's fantastic. Just a different outlook on things. And I think our outlook is driven by these large corporates who are our business, right? That is our bread and butter and will continue to be for a long time.
Fair enough. I think you know who your customer is and you're supporting them.
KYC, know your customer, right?
That's it.
And we know our customer and to date, they haven't been asking for this en masse. So,
Andrew, this has been fantastic. Thank you for taking the time. It's always great to have conversations with landlords and operators together. It's fantastic.
Yeah, it's fun. It's a fun, unique view.
Well, we all need to be talking together to support 100%. Customers. Just looking forward, the next 5 years, we see a period of stability as it pertains to flex. Maybe not necessarily just Brookfield, but in general. What is your outlook for flex? What do you think? What's going to happen?
I think this confluence of co-working, flexible workspace, more broadly defined as built spaces on shorter terms, and amenities is in many ways where the future is going, right? This is Andrew's opinion, not Brookfield's necessarily, of where if you can take these spaces that we're already doing, right? We have amenities in a lot of our assets across the world. And you can take what in many places could be cost centers and put a revenue component to them and also save on the expense side of the business because you're you're kind of allowing for synergies of these two businesses, I think that makes tremendous sense, right? So I think hopefully we start to see a little bit more of that type of business. I also think, and I hope that a large corporates start to use Flex in a very real way, right? And we're starting to see it, right? You saw Allstate made a big announcement, and a couple others. There was one this week, I can't remember who it was, but who said, we're going to take a large corporate office, it's going to be our home for the next 10 plus years, but we're going to allow some of our users to use Flex space when they want it, and we're going to sign kind of these broad deals. That's great. And again, if our corporate users start asking for this, we're going to start building it, right?
Can you see a day where, because the customer asked for it,
yeah,
Brookfield spins up a vehicle with a different investor profile to go buy a fully flex building?
I think fully flex is going to be challenging for us, just given the way we look at it. Again, completely transparently.
Sure.
I think it's better as an add to a strategy that we've been doing for a very long time, rather than, we talk about, we want to be at the forefront, but we want to make sure that whatever our, mistakes, and everyone makes mistakes, right? Whatever our mistakes are, they don't affect anything on a large scale basis, right? We've been doing this for a long time, and we're going to continue to be doing this for a long time. And so the 100% flex, that's swinging for a home run every time, right? I think that's challenging, especially given what's happened in the world and kind of the history of this. I hope I'm wrong.
Well, time will tell. We'll see.
I hope I'm wrong.
Andrew, thank you very much.
Thank you very much.
Really appreciate it.
It's been fun.
Thank you for tuning in. Till next time, take care of yourself.
If you've enjoyed this episode, you'll enjoy our Brave Ideas newsletter. Subscribe today by tapping on the link in the show notes. And don't forget, I'm always on the lookout for buildings to acquire and reposition with brand-led hospitality. If you know a building I should look at, or an owner looking to sell or partner with, drop me a DM or contact us at bravecorp.co. Until next time, take care of yourself.